Ladies and gentlemen, there are moments in economic history when the data whispers. There are moments when it speaks clearly. And then there are moments like this when the numbers are screaming, the signals are flashing red, and almost nobody wants to hear it because bull markets are addictive, optimism sells, hope trends, but risk is ignored until it isn't. Today, I'm not here to comfort you, I'm here to prepare you, not for a routine downturn, not for a mild correction, but for structural shocks building beneath the surface of the global economy, pressures that are invisible to casual investors, but obvious to anyone who studies cycles, debt, liquidity, and history. And if you are overexposed to the wrong areas of this market, the next phase won't just hurt, it will erase. There are 4 sectors where risk is no longer theoretical, risk is now mathematical, and when math turns against a market, emotion doesn't save it. Let's begin. Sector A1, over-leveraged commercial real estate. This isn't 2008 housing. This is something slower, quieter, but just as dangerous. Office buildings across major cities are not temporarily empty. They are structurally obsolete. Work from home didn't fade. It reset demand permanently. You have falling occupancy, collapsing building valuations, refinancing at much higher interest rates, regional banks sitting on loans backed by properties worth 30–50% less than when those loans were made. This is not a dip. This is a repricing of reality. And here's the part most investors miss. Commercial real estate isn't just about buildings. It's tied to bank balance sheets, pension funds, insurance portfolios, municipal tax bases. When property values fall, credit tightens. When credit tightens, business investment falls. When investment falls, growth slows. This is how a property issue becomes an economic issue. If you are holding rights heavily exposed to offices, regional bank stocks tied to property loans, private real estate funds promising stable income, you are sitting in the slow lane of a crash already in motion. Sector A2A, speculative, tech with no profits, innovation drives growth. That's true, but speculation drives bubbles. We've seen this movie. Dot-coms as specs, crypto hype cycles, adjacent companies with no revenue. When liquidity is easy, markets fund dreams. When money tightens, markets demand earnings. The era of growth at any cost is over. The new era is cash flow or collapse. Thousands of companies are valued not on profits, but on future stories, and stories don't pay debt. Stories don't survive high rates. Stories don't withstand investor fear. In every cycle, capital flows from hype quality. The companies with no profits, high cash burn, dependence on constant funding are not early stage opportunities. They are future dilution machines, and when funding windows close, stock prices don't fall 20%, they fall 70–90%. Sector of A3, consumer credit-driven retail and discretionary spending. Look at the surface and consumers seem strong, but look deeper. Savings buffers are shrinking, credit card balances are rising, interest payments are climbing, delinquencies are ticking up. This is not a spending boom built on income, it's a spending extension built on debt. When households hit limits, spending doesn't slow gently, it stops suddenly. And when consumer demand drops, the most exposed sectors are luxury goods, fast fashion, non-essential retail, travel splurges. Buy now, pay later ecosystems. These businesses look strong at the top of the cycle, right before demand cracks. When credit stress hits the consumer, revenue doesn't slide, it falls off a cliff. Sector, wait for highly indebted companies in a high-rate world. For a decade, cheap money hid bad business models. Zombie companies survived by refinancing endlessly. That era is over. Now debt rolls over at higher rates. Interest expenses eat profits, margins compress, companies with weak balance sheets, low profit margins. Heavy refinancing needs, while aren't facing headwinds, they're facing survival math, and math always wins. Defaults rise, equity holders get wiped, loan holders take losses. This doesn't happen all at once. It happens in waves, and we are entering the next one, the bigger picture. This isn't fear, this is cycle recognition. Every bubble convinces investors this time is different. Every crash reminds them it wasn't. The warning signs today are not emotional, they're structural, higher rates, tighter liquidity, slowing growth, record global debt. When those forces collide, weak sectors don't bend, they break. What smart capital does now? Smart money isn't chasing momentum, it's strengthening balance sheets, prioritizing cash flow, reducing leverage, building liquidity, owning pricing power. Because in the next phase of the cycle, survival beats speculation, and patience beats excitement. Final warning, the most dangerous words in investing are, I'll get out later. Later is where crashes live. Later is where liquidity disappears. Later is where buyers vanish. You don't prepare for storms in the rain. You prepare while the sky still looks clear. The risks are visible. The data is available. The only question left is, will you act before the market forces you to? We've covered the 4 sectors, the ticking time bombs of our current economy. But numbers and sectors alone are not enough to spark real action. Let's humanize this. Let's put faces, stories, and scenarios to what's happening. Because markets are not abstract, they are people, and people make mistakes when they ignore reality. A closer look at the human side of commercial real estate. Imagine a mid-sized city. 10 years ago, its downtown was booming. Office towers filled with lawyers, marketers, tech startups, and finance professionals. Today, the vacancy rate is climbing. Companies are downsizing. Entire floors sit empty. The property owners still owe the same loans, sometimes more than the building is worth. Banks are nervous, pension funds are nervous, investors are nervous, and yet many still say it's just temporary. No. This is a structural shift. Office demand will not return to 2019 levels in many regions. And when valuations collapse, the ripple effects aren't confined to buildings. Jobs disappear, municipal tax revenue falls, local economies contract. This is why ignoring over-leveraged commercial real estate is not just risky, it is reckless. The technology lessons from history, let me take you back. Dot-com bubble, 2,000 pets, at zero profit, yet a valuation of hundreds of millions. 2008, financial engineering disguised real losses. 2023 crypto hype, ISPEC mania, AI adjacent startups with sky-high valuations but minimal revenue. All these bubbles share a common thread: confidence divorced from fundamentals. Investors love stories until stories stop delivering cash. And here's the reality. Many of the tech companies dominating headlines today are just modern versions of past failures. They are built on promises, not profits. When interest rates rise, the cost of borrowing rises, and the need for real earnings is non-negotiable. Ask yourself, can this company survive a 20% drop in funding? Can it turn a profit if growth slows? Does it have cash to weather a storm? If the answer is no, it's not an opportunity, it's a time bomb, consumer debt, a crisis waiting to happen. Consider the average household. On the surface, spending is up. People are traveling. Restaurants are busy. Shopping carts are full. But dig deeper. Savings rates are at historic lows. Credit card balances are climbing faster than wages. Interest on revolving debt is rising with the Fed's hikes. This is a fragile foundation. One economic shock, rising unemployment, a sudden interest rate surge, or a housing slowdown could trigger a domino effect. When consumers stop spending, retail chains collapse, manufacturers cut production, and small businesses are crushed. The lesson: consumer strength built on debt is illusionary strength. Markets eventually demand truth. Corporate debt, the silent killer. Cheap money is gone. Companies that survived the last decade on refinancing and low rates are now exposed. Imagine a company with $500 million in debt. Interest rates jump by 2–3%. Suddenly it owes tens of millions more annually. Margins vanish. Profits evaporate. Stock price collapses. It's not speculation, it's math. Investors who ignore corporate debt exposure are placing blind bets, bets that will fail when the market corrects. A message to investors: here's what you need to remember. Liquidity is king. Cash in hand beats paper profits. Diversification isn't enough. You must avoid systemic risk sectors. Be proactive, not reactive. Waiting for a crash is too late. Know your exposure, stress, test your portfolio against higher rates, lower consumer spending, and collapsing real estate prices. History is brutal in its lessons. It doesn't reward hope, it rewards preparation. The choice is yours. You can ignore this warning. You can assume it'll be different this time. Or you can act. You can reduce exposure. You can strengthen your balance sheet. You can protect yourself and your family, your business, your investors. Because when these sectors crash, and they will, there will be no emergency exit, no rewind button, no second chance. Closing words: in my decades in finance, I've seen cycles repeat. The players change, the tools change, the headlines change, but the outcomes remain the same. Debt builds, risk accumulates, markets correct. Those who see it coming can survive, even thrive. Those who ignore it get wiped out. This is not fear-mongering, this is truth-telling, and the time to act is now. We've seen the risks laid bare. We've walked through the numbers, the sectors, the human stories behind the markets. Now let's put flesh on the bones, real-world cases, companies, and trends that illustrate exactly what happens when markets ignore warning signs, because theory only matters when it meets reality. Commercial real estate in action. Let's take New York City as an example. Once bustling, its office towers now report vacancy rates exceeding 20% in many areas. Imagine the landlord with a $200 million mortgage on a building valued at $120 million. The interest payments are crushing. Tenants are leaving, and refinancing is impossible without paying exorbitant rates. This isn't a hypothetical. This is the story of hundreds of buildings across America. Banks that lent on these properties face rising non-performing loans. Pension funds with commercial real estate exposure may have to write down assets. Cities see falling tax revenue affecting schools, services, and public works. A ripple in one sector becomes a wave across the economy. Investors ignoring these trends are not conservative. They are exposed to a slow-moving disaster that will surprise many. Speculative tech companies. Consider the story of a tech startup hyped as the next AI unicorn. It raises $500 million from venture capital, yet generates less than $5 million in revenue. At first, everyone cheers. The stock surges. Headlines call it the future of innovation. But then interest rates rise. Funding slows. Cash burn accelerates. The startup misses payroll. Layoffs follow. And the valuation collapses from billions to hundreds of millions almost overnight. The pattern is decades old. From dot-coms to S-Pakes. This is the classic boom-bust cycle of speculative innovation. If your portfolio is concentrated in companies without profits, you are not investing in growth, you are gambling, and the odds are stacked against you. Consumer debt crisis in numbers. Americans owe over $1.2 trillion in credit card debt. Interest rates have risen, making minimum payments harder to meet. Savings are at a 50-year low in many households. Inflation still nibbles at discretionary income. When even 5–10% of consumers default on payments, it sends shockwaves. Retailers lose revenue. Suppliers cut back production. Small businesses fail. Luxury brands, non-essential goods, and buy now, pay later schemes are first to feel the pain. The warning is clear. Consumer strength based on debt is temporary. Corporate debt and zombie companies. Over $5 trillion of corporate debt is rated below investment grade globally. Many of these companies survived the last decade because of near zero interest rates. That window is gone. Picture a mid-sized manufacturer, $400 million in debt, interest costs doubling in 1 year, margins shrinking from 12% to 2%. What happens next? The company cuts costs, lays off workers, defaults on bonds, and the stock crashes. These aren't isolated stories. This is a pattern in motion, repeating across industries from chemicals to energy to retail. Investors ignoring this debt wave risk total capital loss. Tactical advice, what to do now. If you want to survive, even thrive, in the next market contraction, consider these actions. Audit your exposure. Identify the percentage of your portfolio in high-risk sectors. Stress test each position against rising rates and falling revenues. Increase liquidity. Cash is king in a market crash. Avoid over-leveraged investments. Focus on cash flow and profits. Companies that generate free cash survive. Avoid hype-driven growth plays. Diversify carefully. Not all diversification is safe. Consider defensive sectors, essential services, healthcare, staple consumer goods. Monitor debt carefully. Corporate debt levels, household debt, municipal exposure. Prioritize investments with strong balance sheets. The psychological battle. Markets are emotional. Fear and greed dominate human behavior. During a crash, greed leads people to double down on losing positions. Fear causes panic selling. The disciplined investor acts before panic sets in. Preparation is not pessimism. It is intelligence. It is strategy. A warning that cannot be ignored. We are at a pivotal moment. The next downturn will not be mild. Interest rates are historically high. Debt levels are historically high. Market valuations are stretched in speculative sectors. The next wave will separate the prepared from the unprepared. And history has no mercy for the unprepared. We've seen the numbers. We've explored the human stories. Now it's time to connect the dots, history, current trends, and what this means for your investments. Because markets are cyclical, and those who ignore the lessons of the past are doomed to repeat them. 1. Commercial real estate history repeats. Think back to the 2008 financial crisis. Commercial real estate may not have been the headline story, but it was a silent killer. Banks were overexposed. Occupancy rates fell. Property-backed securities collapsed. Today, we face a different yet eerily similar scenario. Office vacancy rates climbing in major cities, debt refinancing at much higher interest rates, pension funds and insurance companies still heavily exposed. Scenario projection. If office valuations drop by 30–50% over the next 2 years, and there is every indicator they could, then regional banks could face multi-billion-dollar loan defaults. Alright, investors could see share values halve. Pension funds may be forced to liquidate other assets, creating market ripple effects. This is not hypothetical. It is a plausible, historically informed forecast. SpeculativeTech.com lessons applied today. .com crash 2002 companies with sky-high valuations and no profits collapsed some overnight. Fast forward to today, many AI-first or Web3 adjacent companies fit the same profile. Massive valuations based on projected growth, not profits. Heavy dependence on continuous funding, high cash burn rates. Example scenario, a company valued at $10 billion today, losing $200 million per quarter, faces a liquidity crunch in a tighter funding environment. If funding slows or fails, valuation can collapse by 80% or more in months. Lesson: Story-driven valuation is a trap when interest rates are high and capital is no longer cheap. 3. Consumer debt and retail spending, the fragility of borrowed confidence. Let's visualize average household credit card debt T8,000, 10,000, delinquency rates rising, savings rates at multi-decade lows. Scenario: a modest 5% increase in unemployment could trigger mass defaults on credit card debt. Rapid declines in retail revenue. Chain reactions hitting non-essential sectors, luxury goods, travel, entertainment. Historical parallels: 2008 saw similar consumer stress, but today the debt load is even higher, making the next downturn potentially sharper and faster. 4. Corporate debt, the zombie apocalypse. Corporate leverage has grown dangerously high. Companies surviving the last decade on refinancing alone are exposed to rising rates. Consider a company with $100 billion in debt, earning $50 million annually. If interest rates rise 2–3%, this company may not generate enough profit to service its debt. Historical reference: 1990s Japanese zombie companies survived by rolling over debt, but ultimately destroyed equity holders when the bubble burst. Projected impact: defaults increase, bondholders take losses, equity is wiped out. The math is simple: ignore it at your peril. Actionable steps for investors. Let's move from warnings to strategy. The following is what smart capital does before a crash hits. Audit your entire portfolio. Identify exposure in rights, speculative tech, consumer debt-driven retail, and high-leverage companies. Increase liquidity. Cash is a weapon in a downturn. Avoid over-leveraged positions. Prioritize fundamentals. Invest in companies generating free cash flow. Avoid businesses dependent on constant capital inflows. Stress test every position. What happens if rates rise by 2–3%? What happens if revenues drop 20%? What happens if debt servicing doubles? Consider defensive assets, sectors with pricing power, recurring revenue, and essential demand. Psychological preparation, the market mindset. Market psychology cannot be ignored. During crashes, fear dominates, causing panic selling. Greed dominates, causing overexposure. Survivors act before emotion dictates action. They accept reality no matter how uncomfortable. The prepared investor does not hope, they plan. They stress test, they execute early. The moral of the story: cycles are inevitable. Debt builds, speculation rises, liquidity tightens, markets correct. Those who recognize these patterns will survive and even thrive. Those who ignore them will pay the ultimate price. The clock is ticking. The time to act is now. History is watching. Will you be ready? We've seen the history, the numbers, the human impact. Now it's time to talk about survival and opportunity, the decisions that separate those who endure the next downturn from those who do not. Because preparation is more than caution, it is strategy, and strategy requires specificity. Sector 1 team, commercial real estate survival strategies. The risks are clear: high vacancy, declining valuations, and refinancing challenges. What investors should do now: reduce exposure to office-focused rights. Consider shifting toward industrial or logistics-focused rights. Demand for warehouses and fulfillment centers remains robust. Examine loan-backed investments. Avoid banks and funds heavily exposed to regional office mortgages. Their defaults could cascade into your portfolio. Focus on high-quality, low-leverage properties. Buildings with long-term tenants, stable cash flow, and low debt levels are more resilient. Realistic scenario projection: a 30–50% correction in commercial office valuations could wipe out half of current equity value in highly leveraged rights. Investors unprepared could see multi-billion-dollar losses in aggregate portfolios. Sector 2A, speculative tech, red flags and actions. Tech bubbles thrive on optimism, but optimism doesn't pay bills. Red flags to watch: high cash burn relative to revenue, over-dependence on continued funding. High valuations with minimal earnings. Action steps: avoid companies without profit or a clear path to profitability. Stress test valuations against rising interest rates. Consider companies with recurring revenue and strong cash flow. Historical lesson: dot-coms lost 80–90% of market value almost overnight. The same fate could await modern speculative tech. Liquidity tightens. Sector 3, consumer debt-driven retail survival strategies. The illusion of consumer strength is fragile. When debt-driven demand collapses, companies are exposed. Action steps: reduce holdings in luxury, discretionary, and buy now, pay later sectors. Prioritize companies with low debt, essential goods, and subscription or recurring revenue models. Monitor consumer debt indicators, delinquency rates, credit card utilization, and personal savings trends. Projected impact: even a modest 5% rise in unemployment or consumer defaults could trigger a 20–40% revenue decline in discretionary retail. Investors in over-leveraged retail will face rapid and painful losses. Sector fortune: corporate debt, tactical playbook. High corporate leverage is the hidden risk. Many companies are zombies, surviving only because of cheap debt. What to do? Audit your portfolio for companies with debt to EBITDA ratios above 4 or 5. Prioritize companies with strong free cash flow and minimal refinancing needs. Avoid bonds and equities in sectors most sensitive to interest rate spikes. Scenario projection: rising rates could push hundreds of mid-sized companies into default. Bondholders may face losses of 20–50%. Equity holders could see total wipeouts. Portfolio stress: test the Diamond method to prepare for what's coming. Assume a 30–50% correction in commercial real estate and speculative tech. Assume a 20–40% drop in consumer discretionary revenue. Assume rising default rates in corporate debt. Then ask, will my portfolio survive this scenario? Do I have sufficient liquidity to capitalize on opportunities when panic hits? Am I positioned defensively enough to avoid catastrophic losses? Opportunities amid chaos. Markets are cyclical. For every sector in decline, there are sectors that thrive. Healthcare and pharmaceuticals, essential demand, resilient margins, consumer staples, non-discretionary goods, predictable revenue, utilities and energy infrastructure, pricing power, long-term contracts, high-quality industrials, logistics, automation, supply chain essentials. History teaches those who prepare and pivot don't just survive, they profit. The final call to action, ladies and gentlemen. The warnings are clear, the numbers don't lie. The patterns of history repeat themselves with eerie precision. The choice is yours. Ignore the signals and hope for the best, or take decisive action before the storm arrives, because when these four sectors crash, and they will, it will not be gradual, it will be swift, painful, and merciless. Act now. Audit, divest, strengthen, prepare. History will remember the prepared, it will forget the reckless. The market doesn't wait, neither should you. We've warned, we've analyzed. Now it's time to show the stakes, because theory is abstract, but reality bites. Let's examine real companies, real exposures, and potential losses in each sector. 1. Commercial real estate case studies. Case study: Midtown Manhattan office towers. Pre-pandemic value $500 million per tower. Current estimated market value $250–300 million. Mortgage debt $400 million per property. Potential loss: equity could vanish entirely if refinancing fails. Bank exposure to these loans could trigger defaults running into billions collectively. Lesson: high leverage, low demand office assets are ticking time bombs. Right, investors and regional banks alike face serious risk mitigation. Focus on industrial or logistics properties with low vacancy. Avoid high leverage office rights. Consider short-term defensive cash positions until valuations stabilize. 2. Speculative tech, real companies at risk. Case study: AI, adjacency startups. Valuation $10 billion, revenue of $50 million annually. Quarterly cash burn $200 million. Reliance on continuous venture funding. Scenario: funding slows amid higher interest rates. Cash runs out within 6–8 quarters. Valuation collapses 80–90%. Layoffs hit. Equity wiped out. Lesson: story-driven valuations fail when liquidity tightens. Investors must prioritize companies with cash flow and realistic profit potential. Mitigation: sell or reduce exposure to speculative tech with negative earnings. Focus on profitable cash-generating tech companies. Stress test funding dependence against rising interest rates. 3. Consumer debt-driven retail, potential collapse. Case study by now later retail chains. Average customer debt $5,000, $8,000. Rising delinquency rates, dependence on consumer financing for revenue scenario. A 5–10% spike in unemployment triggers mass defaults. Revenue drops 20–40% rapidly. Layoffs follow. Retail closures increase. Lesson: retail dependent on consumer leverage is extremely fragile. Mitigation: shift toward non-discretionary consumer sectors. Avoid retailers heavily dependent on debt-driven purchases. Maintain liquidity and monitor macroeconomic indicators. 4. Corporate debt, zombie companies in the spotlight. Case study: mid-sized manufacturing firm, debt $100 billion, EBITDA $150 million, interest coverage ratio 1x. Scenario: interest rates rise, percent B, interest payments double, margins shrink, dear potential default within 12–18 months, equity wiped out, bondholders face 20–50% losses. Lesson: high leverage plus low cash flow equals catastrophe waiting to happen. Mitigation: audit portfolio for debt-heavy firms, prioritize companies with strong cash flow, avoid sectors highly sensitive to rate increases. Sector-wide projected losses. Here's a realistic aggregated projection if the scenarios unfold. Sector: potential downturn, investor impact, commercial real estate 30–50%, major REITs down 40–60%, banks exposed to defaults. Speculative tech 79% equity wiped out for non-profitable startups. Consumer discretionary 20–40%, retailers reliant on credit see rapid revenue collapse. Corporate debt defaults rising 20–30%, high yield bonds down 20–50%. Equity wiped out. Total portfolio impact: a diversified but highly leveraged investor could see 30–60% losses if exposure is unmanaged. Strategic action plan, the Dimon method. Immediate audit, identify risky positions in all 4 sectors. Liquidity build, up maintain cash reserves to weather downturns. Deleveraging, reduce exposure to high debt assets. Sector rotation, move into defensive cash generating industries. Stress test your portfolio, assume worst case scenarios, then act, plan opportunistic entry points. When panic hits, high quality assets can be acquired at discounts. Psychology of survival, remember, the biggest risk isn't the market, it's investor behavior. Fear causes panic selling. Greed encourages doubling down on weak positions. The prepared investor acts before the panic, not during it. History favors the disciplined and strategic, not the hopeful. Closing thought. Ladies and gentlemen, we've mapped the dangers, illustrated with real-world examples, and provided concrete strategies. The question is not whether the market will shake. It will. The question is, will you be ready when it does? Every day you wait, exposure grows. Every day you delay action, risk multiplies. The time for preparation is now. Audit, reduce, diversify, stress test, and position yourself for survival and opportunity. History is watching. Markets are unforgiving. Only the prepared will endure. Numbers tell one story, charts tell another. But history whispers, and sometimes it shouts through the lives of those who faced a crash and those who didn't. Let me take you into the rooms, boardrooms, and trading floors where fortunes were made and lost. Scene 1. The boardroom of a struggling right. Picture a skyscraper in downtown Chicago. The CEO stands in front of the board, tension thick in the air. Tenants are leaving. Debt payments are due next quarter. The refinancing market has frozen. The CFO flips through spreadsheets, red ink everywhere. One wrong decision could mean hundreds of millions lost. A board member whispers, maybe it's temporary. The CEO slams the table. No, the vacancy trend is permanent. If we don't act now, this company is finished. This is commercial real estate in crisis where indecision costs millions. Scene 20, Startup HQ, the speculative tech trap. Imagine an office buzzing with engineers at a trendy AI startup, valuation toy 10 billion, revenue barely enough to cover salaries. Investors cheer every new funding round. Then the emails arrive. Venture funding slows. Cash reserves are dwindling. The CFO tells C have 6 months before we burn through everything. Engineers keep coding, oblivious. The marketing team still brags about unicorn status. And then, like a guillotine, the reality hits. Layoffs, valuation collapse, panic. This is speculative tech. Hope without profit is a lethal combination. Scene 30, retail floors and debt-fueled consumers. A shopping mall in suburban America. Foot traffic seems normal, but behind the scenes, credit card delinquencies are rising. Buy now, pay later defaults climb. Luxury stores are quietly closing. Store managers worry. What happens if the next economic shock hits? It doesn't take a recession to cause panic. One small nudge, rising interest rates, a sudden unemployment spike, and sales drop 30% overnight. This is the fragile foundation of consumer spending. Debt masks reality until it doesn't. Scene 40, corporate debt zombies walking. Picture a mid-sized manufacturing company in the Midwest. Machines hum, workers clock in. On the books, $1 billion in debt. The CFO runs projections, interest payments double next quarter, margins shrink. Suppliers demand cash up front, customers hesitate. The CEO tells the board, we'll either restructure now or we face bankruptcy in 12 months. The room goes silent. This is the corporate zombie problem. Companies that look alive but are financially terminal. Scene 50, the investor at the desk. Now imagine you a portfolio spread across all 4 sectors. You read the headlines, glance at your statements. Do you panic and sell at a loss, hope the market bounces back, or act strategically, auditing exposure, reallocating assets, and building liquidity? History has an answer. The prepared survive. The unprepared pay painful, lasting consequences, turning fear into strategy. Scenes like these aren't fiction. They are happening across the country and the globe. But here's the truth. Crisis breeds opportunity. Companies with strong balance sheets thrive. Investors with liquidity can buy discounted assets. Those who act early not only survive but profit when fear dominates the market. The moral act before panic hits. The market doesn't wait for sentiment. It doesn't pause for hope. Commercial real estate make hard decisions before vacancies rise further. Speculative tech focus on cash flow, not hype. Consumer-driven retail reduce exposure to debt-dependent spending. Corporate debt prioritize solvency, minimize leverage. Waiting is the costliest mistake you can make. Closing words for part 7. Ladies and gentlemen, I have shown you numbers, projections, and now stories, real life scenes where fortunes and futures hang in the balance. The next crash will not be gentle. It will be swift, relentless, and unforgiving. The question is not whether it will happen. The question is, will you be ready? Audit, divest, stress, test, position for survival, and opportunity, because history favors the prepared and time is running out. We've walked through history, real numbers, human stories, and sector by sector analysis. Now it's time to connect all the threads to see the full picture and understand the actions required to survive and thrive in the coming storm, because knowledge alone is not enough. Action is everything. The anatomy of a market crash. Every crash follows a familiar pattern. Excess leverage accumulates. Banks, companies, consumers take on more debt than they can service. Speculative bubbles inflate valuations far above reality. Liquidity dries up. Funding slows. Refinancing becomes costly or impossible. Confidence collapses. Panic spreads. Markets sell off rapidly. The fallout occurs. Companies fail. Investors lose capital. Ripple effects spread across the economy. Today, all four sectors we've discussed exhibit these vulnerabilities, and in many cases, the warning signs are blindingly obvious. Sector by sector crisis map 1, commercial real estate, the slow-moving avalanche. Vacancy rates in major U.S. cities have surged, particularly in office spaces. High leverage means defaults could cascade into banks and pension funds. Industrial logistics properties remain relatively stable, but traditional office rights are vulnerable. Actionable steps: avoid high leverage office rights, increase allocation to industrial logistics real estate, maintain liquidity for potential distressed asset opportunities. Projected impact: 30–50% valuation drops for office-focused assets, multi-billion-dollar defaults for banks with concentrated exposure. 2. Speculative tech, the illusion of growth. Startups burning cash without profits are overvalued. Dependence on continuous funding is a major risk. Interest rate increases expose financial fragility. Actionable steps: sell speculative, unprofitable tech holdings. Invest only in companies with recurring revenue and strong cash flow. Stress test exposure to a funding slowdown or valuation collapse. Projected impact: 70–90% losses possible for overhyped tech firms. Rapid layoffs. Operational shutdowns and equity wipeouts. 3. Consumer debt-driven retail, a fragile foundation. Rising credit card delinquencies and buy now, pay later defaults. Low household savings rates exacerbate vulnerabilities. Retail dependent on discretionary spending is most exposed. Actionable steps: reduce exposure to debt-dependent retailers. Focus on essential goods and subscription-based revenue. Monitor macroeconomic indicators such as unemployment and consumer confidence. Projected impact: 20–40% revenue declines in discretionary retail. Bankruptcy risk for over-leveraged retail chains. 4. Corporate debt. Zombies walking among us. Many mid-sized firms are highly leveraged. Rising interest rates threaten solvent zombie companies. Survive only through refinancing, not profitability. Actionable steps: audit portfolio for debt-heavy firms. Prioritize companies with strong free cash flow and low refinancing risk. Avoid sectors most sensitive to rate spikes. Projected impact: defaults increase 20–30%. Bondholders could lose 20–50%. Equity holders could see near total wipeout. Investor psychology, the secret weapon. The greatest risk in a crash is emotional decision-making. Panic selling amplifies losses. Greed drives doubling down on failing positions. Hope ignores reality. The prepared investor acts before panic strikes. Stress tests assumptions and executes strategically. That discipline is more valuable than any market tip. Opportunity amid chaos. Even in crisis, opportunity exists. Healthcare and pharmaceuticals, resilient demand, strong margins. Consumer staples, predictable revenue from essential goods. Utilities and energy infrastructure, pricing power, long-term contracts. Industrial logistics, essential supply chain services. History teaches those who act decisively during panic profit massively when fear dominates the market. Practical survival blueprint. Immediate audit: identify high-risk exposure in all four sectors. Liquidity build up, maintain cash reserves for safety and opportunistic buys. Deleveraging, reduce debt, heavy positions and speculative investments. Stress test portfolio, model worst-case scenarios and act preemptively. Rotate to defensive sectors: healthcare, staples, utilities, logistics. Monitor indicators, track interest rates, consumer debt, corporate defaults. The final call: ladies and gentlemen, this is not fear-mongering. This is reality. The storm is forming, and its intensity will test every investor, company, and institution. The question is simple. Will you wait for the crash to force your hand, or will you act now, audit your exposure, divest strategically, and position yourself for survival and opportunity? The markets do not wait. They do not negotiate. They do not forgive. History favors the prepared, and the time to prepare is today. We've mapped the risks, the numbers, and the human cost. Now it's time to go deeper. Each sector we've discussed deserves its own chapter, its own story, because the dangers and strategies are unique. We will begin with commercial real estate, the slow-moving avalanche. Chapter 14, commercial real estate, the slow-moving avalanche, historical parallel. 2008 financial crisis, over-leveraged properties, declining occupancy, and risky mortgage-backed securities caused a cascade of bank failures. Japan in the 1990s. Commercial property stagnation led to zombie banks holding toxic assets for years. Real-world Casey. Midtown Manhattan office towers pre-pandemic value $500 million. Current estimated market value $250, $300 million. Mortgage debt $400 million. Scenario. Refinancing fails. P defaults rise. Gear right shares collapse. Regional banks face multi-billion-dollar exposure. Investor strategy. Avoid high leverage office rights. Shift to industrial logistics rights with strong tenant demand. Maintain cash reserves for distressed property opportunities. Key takeaway: commercial real estate crashes slowly, but the impact is deep and systemic. Acting early separates survivors from casualties. Chapter 2 Speculative Tech, the illusion of growth, historical parallel. Dot-com bubble companies with sky high valuations and no revenue imploded. Pets. Com is the textbook example, real-world case. AI, adjacency startups, valuation $10 billion, revenue $50 million. Quarterly cash burn $200 million. Scenario, funding slows, the cash reserves run out, layoffs and valuation collapse to 80-90%, equity wipeout. Investor strategy, avoid speculative, unprofitable tech, focus on recurring revenue and cash flow. Stress test against rising interest rates. Key takeaway: tech stories don't pay bills, profitability and cash flow do. Chapter 30, consumer debt, driven retail, fragile foundations, historical parallel, 2008 consumer crash. Credit card defaults, falling consumer confidence, and bankruptcies in discretionary sectors caused ripple effects across the economy. Real-world case. Buy. Now, pay later retail chains, average customer debt $5,000 and $8,000. Rising delinquency rates, dependence on consumer financing. Scenario, a small rise in unemployment triggers defaults. Revenue drops 20-40% to retail closures and layoffs. Investor strategy, reduce exposure to debt-dependent retailers. Focus on essential goods and subscription services. Monitor macroeconomic indicators like unemployment and savings. Key takeaway: debt-fueled consumption is illusionary strength. When reality hits, revenue collapses. Chapter 40, corporate debt, zombies walking, historical parallel. 1990s Japan, zombie companies survived on debt rollover, destroying equity holders when the bubble finally burst. Global corporate debt today over $5 trillion, and high-yield corporate debt is at risk in a rising rate environment. Real-world Casey, mid-sized manufacturing firm, debt fee $1 billion, EBITDA $150 million. Interest coverage ratio 1.5x. Scenario, rising interest rates double interest payments, margins shrink, potential bankruptcy in 12-18 months, equity wiped out. Investor strategy. Audit for high debt to EBITDA companies. Prioritize strong cash flow, low refinancing risk. Avoid sectors highly sensitive to rates. Key takeaway: zombie companies may look alive but are financially terminal. The psychological thread. Across all sectors, the common factor is human behavior. Fear triggers panic selling. Hope leads to reckless holding. Discipline wins. Prepared investors act before the panic. The unprepared pay the ultimate price. Call to action. Audit your portfolio. Divest from high-risk sectors. Build liquidity. Stress test every position. Rotate into defensive sectors. The storm is forming. The difference between survival and devastation is how quickly you act. We've walked through the numbers, the history, the human stories, and the sector-specific crises. We've explored real companies, projected losses, and tangible strategies. Now, the final truth: this is the moment where preparation determines destiny. The storm is here. It is not coming. It is forming in plain sight, and it will test every investor, every company, and every portfolio. The four sectors in perspective: commercial real estate, the slow-moving avalanche, vacancy rates climbing, refinancing challenges threatening banks, action, divest high leverage assets, focus on industrial logistics, maintain liquidity, speculative tech, the illusion of growth, sky-high valuations with no profits, vulnerable to funding slowdowns and rising rates, action, focus on recurring revenue, cash flow, and profitable companies, consumer debt, driven retail, fragile foundations, rising credit card delinquencies and debt defaults, vulnerable to economic shocks, action, reduce exposure to debt-fueled retailers, prioritize essential goods and subscription-based models, corporate debt, zombies walking among us, companies surviving only on refinancing, rising rates threaten solvency, action, audit debt, heavy firms prioritize cash flow, avoid highly rate-sensitive sectors, the investor's survival blueprint. Now, let's distill the strategy into clear, actionable steps. Immediate audit, identify high-risk positions across all four sectors. Liquidity, build up cash's power during market stress. Deleveraging, reduce exposure to speculative, highly leveraged or debt-heavy assets. Portfolio stress, test model worst case scenarios, falling revenues, rising interest rates, consumer default, sector rotation, move toward defensive sectors, healthcare, consumer staples, utilities, industrial logistics. Monitor economic indicators, interest rates, corporate defaults, vacancy rates, consumer debt. Prepare to act decisively. Opportunities arise when panic dominates. The prepared can profit. The human stories behind the numbers, CEOs staring at red ink across spreadsheets, Engineers working in a startup oblivious to funding slowdowns, retail managers watching foot traffic while debt-fueled sales mask risk, investors hesitating, hoping the market bounces back. These stories are not hypothetical. They are happening now. They are unfolding in real time. The difference between survival and devastation is how you respond proactively, decisively, and with discipline. Opportunity in crisis, even as markets collapse. High-quality assets are discounted. Profitable companies with strong balance sheets thrive. Liquidity allows investors to buy at lower prices. History rewards those who act early, not those who hope for the best. The final warning: markets do not wait, markets do not negotiate, markets do not forgive. The next downturn will be swift, relentless, and unforgiving. Waiting is the costliest mistake. Ignoring exposure is reckless. Hesitation will amplify losses. The time to act is now. Audit, divest, stress, test, reallocate. Prepare the closing call, ladies and gentlemen. The four sectors: commercial real estate, speculative tech, consumer debt-driven retail, and corporate debt are on the precipice. They are not minor risks, they are systemic threats. But there is a path forward, a path that separates survivors from casualties, winners from the wiped out. Discipline, make decisions before panic strikes. Liquidity, cash in hand, is your greatest weapon. Strategic diversification, rotate to sectors that endure and grow. Preparedness, stress, test your portfolio, anticipate risk, act. History favors the prepared. Markets punish the unprepared. This is not fear-mongering. This is truth-telling. The storm is forming, and the choice is yours. Will you wait for it to hit, or will you act now decisively, strategically, and wisely to protect your capital and your future? The time is today. The stakes are immense, and the consequences of inaction are irreversible.